The Federal Reserve ended its March meeting leaving their Fed funds rate unchanged, but what was perhaps more interesting was what they released in their updated economic projections. In today's video, we're going to look at their latest projections for the economy and rate changes and what it all means for mortgage rates and the housing market. Let's get into it. The Fed ended their meeting on March 19th, leaving their Fed funds rate unchanged, which was widely expected. The more meaningful information came from comments from Fed Chair Jerome Powell during his press briefing and the Fed's updated economic projections. The lack of an additional rate cut shows some discomfort with the current level of inflation and more inflation that might come down the road due to President Trump's tariffs. The other side of this is that the Fed does see the economy as strong enough that they don't need to lower rates right now to support it, although they are projecting slower economic growth compared to their prior projections. Higher inflation and slower economic growth have sparked some fears that we might enter into a period of stagflation. Stagflation can be a double punch to the gut for the average American. Not only would you have higher prices, which strains household budgets, but you also have slower economic growth, which can limit the prospects for seeking gainful employment and increasing income. Now, we aren't experiencing stagflation right now, but let's take a look at the Fed's economic projections to see why some fears are being raised because of it. The Fed is now projecting real GDP growth to come in at 1.7% for all of 2025, which is down from their December projection of 2.1%. The unemployment rate projection edged up slightly at 4.4% for 2025, up from 4.3% in their prior projection. And consumer inflation is expected to come in at 2.7% for 2025, up from 2.5% in their prior projection. They didn't make any change in their projection for the Fed funds rate. It is still 3.9% for 2025 like it was in December, which implies that they still project to make 225 basis point rate cuts this year. The takeaway from their updated projections is in line with what we heard from Powell at the press conference. They are expecting higher inflation and slower economic growth, but they also don't see the economic and inflationary trends to stand in the way of them making a few more rate cuts this year. Now, what does this all mean for the housing market? When it comes to changes in interest rates, the first thing that comes to mind is mortgage rates. And for that, we need to look at what is happening in the bond market. The yield on the 10-year Treasury bond, which mortgage rates track very closely, didn't make any big moves as a result of the Fed's meeting. Yields have come down from recent highs in large part to what has been happening in the stock market the last month or so. Stocks have been selling off over uncertainty regarding President Trump's tariff policies. When stocks go down, treasuries are typically where investors go for safety. And when demand for treasuries is up, the price goes up and the yields go down, given that prices and yields go in opposite directions. In the meantime, the average rate on a 30-year fixed-rate mortgage has also come down over the last month or so, in line with the trend in treasury yields. Looking forward, mortgage rates are likely to stay in a range between 6% and 7% in 2025, and that is largely where they have been over the past year. For it to break out of that range, we have to think of what would have to happen to get some big movement in treasury yields. A severe economic recession would likely do that, but there isn't one on the immediate horizon. A sharp increase in inflation due to a severe tariff trade war would also likely move treasury yields, but it is too soon to see how President Trump and our trading partners are going to carry out what looks like a brewing trade war on the horizon. So unless we get some kind of big events like those, I think it is safe to assume mortgage rates are going to stay between 6% and 7% for most of the year. This means buyers in the housing market are going to continue to be faced with affordability challenges unless home prices come down. Unfortunately, more of the same in the housing market is what is expected in the months to come. If you want to stay up to date on all the developments affecting the economy, mortgage rates, and the housing market, make sure you are subscribed to this channel and hit that notification bell down below so you won't miss my next video when it comes out. Let me do the research for you, keep you up to date. If you liked today's video, don't forget to hit that like button to support the channel and help it grow. Thanks for stopping by, and I'll see you in the next video.